One of the things that we were talking about this morning was this idea that the volatility index, like Spike, made a 1 month low. And I think this probably goes back to a low to 2020. The scuttlebutt around particularly FinTwit was that, okay, it looks like vol went down, but in actuality, if you look at on a fixed strike basis and some other measurements, volatility actually seemed to go up. And so I was super excited to have you here to kind of walk us through these different concepts and ideas. So spikes hit a 1 month low, but if we look at different measurements of volatility, again, it looked like volatility went up. So what I wanted to do was, I'm going to set this up for you here. When you look at term structure in this case, we talked about this in our subscriber notes a lot, so everyone here is familiar with this, but at the money implied volatility went down. And this is a week over week basis. You could have looked at it on a day over day basis. And this is, the white line is Friday's expiration and the red line is Thursday. And I highlighted in green the roughly 30 days to expiration because that's what these volatility products use. And as you can see, it looks like implied volatility took a drubbing on Friday. And again, the VIX hit these new lows, et cetera. So what does this actually mean, or what's the kind of appropriate way to look at that? And for this, I think we all understand this term structure chart looking at the money. I wanted to flip over to this slide, which shows fixed strike volatility. And this is where I'm going to hand the baton to Tom, who is the real all-star here in understanding how to disseminate this.
Yeah, so I always like to reference one thing. When everybody's analyzing volatility and talking about volatility, they tend to look and think about what they see current, whether it's VIX spikes, at the money implied volatility, and that's in terms of percentage of the at the money. So you think about what in the previous slide where you had 100% moneyness, you're looking at the at the money volatility as the market moves to a new, so the at the money is at a new strike level,
right,
in dollar terms. So in percent terms, what you have here is like, if I was analyzing vol, I'd be like, oh, it's a lot lower than it was a week ago. But once you, I always like to say, once you strike a trade, or once you put a trade on in the fixed strike world, you're subject to the implied volatility of those options that you have now in the portfolio. You can no longer look at the VIX or any kind of moneyness analytics to predict if you're going to make or lose money, or to backtrack to look back at your P&L changes. So once that happens, you have that trade on. I always liken it to, this example is a great one to show from the 2-day change here. I had a position on once, long a lot of volatility in Vega, option Vega. And I remember the boss of mine once came over and was like, man, you must have killed today, because he looked at the VIX index, which had rallied, market VIX had gone down, S&P had rallied, but fixed strike volatility went higher. I actually made a lot of money that day because we were long option volatility. Forget about the gamma impact, but yeah, so it's an interesting one to think about. You can't look at that. So I always like to think of it as, when I'm analyzing volatility, I like to look at the percentage where you are now, and once I have a position on, or I want to back test the position on, I think about fixed strike volatility, because that's actually what you have in your books. Now, that is different if you're trading, some exotic derivatives that do float with the at the money, similar to VIX options, spike options, futures. Those will be impacted by that floating strike concept.
Right. So the floating strike concept, when you talk about this, is when you're basically looking at volatility from a moneyness perspective. Like on this skew chart here, we have moneyness on the x-axis.
Yes. And you got to remember one thing too, is on the red line here, the first, as the market rallied from that green arrow, that's where we were, 42, whatever.
42.20 is where the market was on Thursday's close.
We rallied up to that much higher strike, right? So the 42.80-ish or so.
42.80.
That's kind of how, what's being, we call it the implied move. So this is what would be the implied move in kind of a, there's a little bit more of the math that goes into it, but we would apply that would be the vol change in a spike index in its most basic form, or VIX index. At the way vol is going to move down.
So just to kind of drill this last point home here, you touched on it quickly, but on Thursday's close, the at the money option, the S&P closed right here at 42.20, with the at the money had an applied vol of roughly 12.5. And then on Friday, we closed at 42.80. And if you looked at what the 42.80 implied vol was on Thursday night, it was 11.5. And so all that happened with that, the VIX or the 1 month, at the money vol coming down, was just we slid down kind of this curve here, right? And that can be shown if you look at the money vol here, where this is 100% of the money, is to your earlier point, where this goes from the numbers I just mentioned, which is 12.5 to basically 11.5, right? So that at the money volatility, when you look at it from the moneyness perspective, it looks like vol dropped, but in fact, all that happened was we kind of slid down this curve, right?
Yes, exactly.
Now, the other key point here on the fixed strike term, though, is this white line is Friday. And so the 42.80 implied vol actually did go up on a fixed strike basis. Vol did go up here, right?
And you can see on the upside there, the calls actually outperformed even greater than on on a relative basis, the at the money. And that's why in my skew graph, why, most of the skew effect is on the upside, or flattening of the skew. The way I measure it, 25 delta here, was from the upside. If I could pull this up right now, I can't do it live, but 25 delta call versus the at the money call, you would really see all this change happening on the call wave. You have to put wave.
I had actually plotted what I think that is here. This is something I was actually running separately this morning. And I hadn't fact checked this particular slide. There's some code I was writing, so everybody take this one with a grain of salt. But this spike here, so basically what we're saying is what did the 25 delta call IV look like versus the 50? And it looks like, along with record S&P index volume on Friday, this kind of made it look like those out of the money call implied balls popped quite a bit.
Yeah, perfect.
Got to use my test code, so that's always good. Okay, so I hope that frames the idea of what happened in the fixed strike vol world versus kind of when you're looking at some of those indicators. But the sort of last point on this fixed strike, one of the things that you had said before, and I just want to hammer this home because I thought it was so interesting, is that when you were looking to set up a trade or get into a trade, you would look at, and correct me if I'm wrong in this, but the moneyness, and you kind of look at these more kind of basic higher levels measurements of volatility. But what you said, and you touched on it again, I just want to hammer it home. It's like once you have the trade on, your risk is in fixed terms, right? So
fixed strike, yep.
Fixed strike vol terms, right?
Implied vol, the fixed strike, yes.
Right. And I thought that was so insightful because it's hard, mentally to sort of shift between that, but it makes sense. Like I bought whatever the 3,900 put, like that's what I own now. I'm subject to that vol, not what, the VIX or whatever maybe doing.
Well, think about it too. If you're like, let's say you're doing a back test of a trade and you're using the 100%,
Right.
You can't, because it's not the right, it's, once you do that trade, it's a different structure you have on. So unless you're trading in that, percentage world.
Right.
But normally most of us are trading in the fixed strike world.